Hi, everyone. Well, it's a stock market update. It's an additional one. And I'm going to do a few of these over the quiet Christmas period because a lot of people are interested in improving their pensions and they've got a bit of time to take financial stock. And of course, with New Year's resolutions coming up, they've got the motivation. So they've got time and motivation, two of the things that you need in order to get on with it. Now, let me know you can see and hear me where you're from. If this is the first time you're on one of mine, it'd be wonderful to know where you're from. Peter, good morning from Auckland, New Zealand. Thank you. We've got Sussex in the room and everyone else. You should also be able to hear me loud and clear. Now, I've got a heck of a lot of new slides for you, so I'm going to share the screen straight away, in actual fact, because there is so much to show and share with you. So you'll want to grab a comfortable chair, pen and paper, probably a camera phone so you can take pictures of certain things which are going to be coming up. I apologize for the late hour. It's really just slotting these extra webinars in just because there's been so much request. Lee from Gummersall. I know Gummersall. I went to school in Fulneck, which isn't too far. We had a lot of Gummersall. I had a girlfriend from Gummersall. Scotland, Egypt. Wonderful, fantastic. I've been to Sharm el Sheikh and I've been to Cairo. Wonderful. Nottingham as well in the room. Buckinghamshire, Gloucester, Posho, Theo and Guy. Welcome one and all, and let me get on with what I want to show you. I want to make sure you can see the screen. You can indeed. So straight away, right into it, because there's a lot to go. Just as a reminder, and I'm really going to focus on this because I've had a lot of emails from you. There's people who are about to reach pension age, and there are those who've already got it who are saying, look, I'm worried about growth. I've got 20-somethings, very few of these, but a few of you in your 20s saying, look, I want to plan well in advance. God bless you because you're planning in advance, and that's good. Then there's those who just say, listen, I keep hearing that stock market's at all-time highs. I feel I'm missing out. My money's not working hard for me. I'm slogging in a job. What the hell's going on? Why am I getting screwed and missing out? And this usually leads to them blaming their financial advisor. So you're probably on this call for that reason. Fed up with so-called lack of growth. In these, I'm going to show you the problems. I've got some new slides to show you this. You're pretty much suspicious that your IFA, who got his exam because he passed a bunch of multiple choice questions with a 60% pass rate, is pretty clueless as to the markets. And you're fed up with UK companies just not performing anyway. And we're going to discuss all of these things. So these are the reasons why you're here. Now, I've been doing this for 25 years plus, explaining to various audiences the markets from my books, from my Financial Times columns. I've been written about in the press as a result, commentating on the BBC and so on. So this has got a big pedigree, and that's important because you need to know who the heck are you listening to. Newsnight discussing various bits of international trade and so on, right? So credentials built up. Let's get on with the meat of it. This is tonight. S&P 500 rises to begin holiday shortened week. Tech stocks lead the gains. Well, we'll put that into a context because, of course, our biggest worries are, well, is it a bubble? Is it overexpensive? Can it continue? What if it pulls back? How much risk are we taking? How long should we hold these stocks? Should we have any of these at all? Should we be moving at other things? What happens? What's the holding period? How much money should go into each? How do we decide? How can we make it simple so that we're not spending all our time monitoring? What about when the falls happen and then there's pullback? Should I panic? How do I avoid that panic? Also for this year, we're going to answer all of those. We're going to answer all of those questions. Also, right now, as of tonight, MicroStrategy, some people looking this up, 477% gain in 2024. Okay, fine. NVIDIA, Broadcom is apparently the next AI chip. So when you read headlines like this, and this is from today, what does that mean? Does it mean that there's similar opportunities elsewhere? How do we get in them? What about those ones? Are they still worth getting into? What do we do? So I looked at these, and I pulled up from my private Telegram channel. This is for people on my Great Investments Program from May the 2nd, 2023. Okay, I'm extremely proud and pleased to say we're trialing ChatGPT AI with Great Investments Program approved list. So we have the Excel approved list, you'll know. I will share insights from AI. For instance, this came up, Broadcom, high croaky, cash return on capital invested, low peg, suggesting efficient capital allocation, potential and valuation, and so on. So that was Broadcom, which came up. What we did is we fed our database, which is this. This is what people have access to on the Great Investments Program. And we need everything to be green. Now, what we do is we work for you to give you the data and then give you the education so you know how to use the data and give you access to me so you can access the data. So what had interestingly happened since AI is all in the news and that Broadcom thing, and just to give you an example of how we use it as you all settle into the room, is that the way we did it, I'm just checking the screens, making sure everyone's here. Yeah, fantastic. The way we did it is we fed all this data in, and then we asked AI and giving it the data as most important. We need all these first 5 columns to be green. So none of these stocks are good enough for us, okay, just so you know. And we fed it a lot of data. If you know anything about anything, you know that data is critical, and a lot of data is critical. So we took all 9,600 stocks which are eligible to be in my SIP or ISA, New York Stock Exchange, BATS, NASDAQ, London Stock Exchange. We fed it all in, and it came up with, amongst others, and this is from May 2nd, 2023, Broadcom. And of course, Broadcom has been powering ahead ever since. So AI picked, here's the interesting thing, it picked a stock based on AI, which is an AI company. Anyway, did I know Broadcom was going to be successful? No. If I knew that, and this is where people get wrong what I do, I'm not a stock picker or stock forecaster in the sense that I look at this and know some story about, I don't know, Broadcom or anybody else. I look at the data. Let's be absolutely clear. I'm not as clever as people think. I look at the data value. Is it undervalued? In other words, lots of profits, share price is low per profit. Okay. Cash return on capital invested, that comes from Goldman Sachs Wealth Management. Growth, revenue growth, i.e. sales growth, and growth in profits. Momentum, hedge fund industry. Sortino, high average returns, low risk of missing that. Rarely misses high average returns consistently, okay? Alpha, market goes up, it goes up more. Market falls, it should still go up more. None of that guarantees it'll move in the future. Now, none of these are good enough, because when you've got that much data, what you do is you say, none of these, by the way, none of these, not good enough, not good enough, not good enough, not good enough, not good enough. None of these are good enough, okay? None of these. Look at this. None of these are good enough because they all got a hit, all green up here. So we filter that down from 10,000 to 200. Now, what was interesting is when you've got AI, that can happen like this, and it can double check your homework, and it can point out things you might have missed or not given enough emphasis. Anyway, one of the big successes was Broadcom. I'm not saying I'm going to completely automate and make myself redundant and just have the machine picking these and giving my child's inheritance to ChatGPT and it just buying these, just like a self-driving car. I'm not going to do that. Okay, not yet. I'm not going to do that any more than I'm going to put my 6-year-old son in a self-driving Tesla. Okay, I'm still going to be at the wheel. However, my God, did that make my life easier? That's all. That's all. Okay, so don't overinterpret this. It is not, I'm going to put my 6-year-old in a self-driving Tesla, or I'm going to put my son's inheritance on AI. All I'm saying is, my God, did that make it interesting and a lot easier. Another one we had from January 2023, I found it on our Great Investments Program. I've purchased the previous special situation charts mentioned above. Now, Disney, wobbly ride. Taiwan semi, not too bad. Nvidia, 2023, January 2023. Now, notice how I didn't say, oh, I think Nvidia is the best one. I didn't know. Tesla, I didn't say Tesla's the big one. Livelation, I think this year's at all-time highs. I didn't say this is the big one. And the point is, when we get into stuff, we look at the data. If we knew Nvidia out of that lot from January 2023 to today was going to be the biggest selection, then I would have said, put all your money in Nvidia. I didn't know that. So let's be absolutely clear about the limits of what I know. Let's go back to January 2023. Okay, this is January 17th when we got into it. Okay, to today. Right? That's gone up 683%. Had I known it's going to go up 683%, by the way, it had previously fallen 66%, which it wasn't when we have ever had it. Okay. had we known it's going to go up 683%, I would have said buy this and nothing else. Had I known anything about AI, I would have said buy this and nothing else. So how come that 683% ends up in my son's junior ISA? Well, actually, it ended up in mine, not his, because his has different holdings. I'll come to what's in his in a moment, from January 2023. And why is it one of several and not just the only one you picked, Alpesh? Because we just looked at the data. The data didn't tell us a narrative or a story. It just told us, and this is the data, just in case you're wondering, what bloody data are you talking about? This data. We had green on the value, growth, income, cash flow, Sortino, and we had strong rising momentum. Okay? The value growth income algorithm, which I've created here, was created because if you're going through 10,000 CVs and all companies are factories for making money, if you're going through that and you don't look at undervalued companies which are showing growth and dividend yields, then you're gambling because you're ignoring relevant information. If anything in life, if you ignore relevant information, you're gambling. Well, how do we know undervalued companies do better than ones which are overvalued, or high growth companies do better than low growth ones, or dividend yielding ones tend to do better than the opposite, or there's exceptions to all these rules? Well, we know this from the work of Nobel Prize winner Eugene Fama, for instance, okay, who I've lectured about in my lectures and written about in my books. So I just stole from a Nobel Prize winning economist and applied it to a spreadsheet. That was it. And I set up the hedge fund in 2004, but that's not the purpose of it. What I'm saying is we institutionalized an approach, which is a whole different story. I'll come to that later on. Anyway, we're going to touch upon some of this today as well. We're going to touch upon this as well. Barry said, I've read reports Musk might IPO Starlink. Yeah, of course he is. The report came from me. I said it, Barry. I said it after Trump won and the market rallied. I said, Trump's not Musk is not an idiot. He's going to IPO the hell out of everything. You've got an all-time high in the markets. SpaceX is going to IPO. He's going to IPO every single one of his private companies. I put it on our Telegram channel because why would you not raise capital at a ridiculous valuation when the president's your best friend? Because two things are going to happen. Might not be the all-time highs forever, and the president's going to fall out with you sooner or later. So sell that damn thing now and get it rocketing ahead. So yeah, we tend not to go directly into. Hi, Guy from Gloucester, first time welcome as well. Okay. Now, this is one of the reasons I do this, because look at what I just talked to you about, and these are what the fund managers do. Okay, that's St. James's Place Global Quality, minus 27% over 3 years versus the benchmark, minus 12%, minus 12, minus 37. So if you've got any funds, whether you're in a workplace pension or wherever you are, I'm going to give you a red alert right now. I want you to find out who you're invested with through your employer or yourself. If it's St. James's Place funds or Fidelity, okay, or Bailey Gifford or Lion Trust or Threadneedle or Jupiter, I want you to panic. I don't want to scare you, but I want you to panic because I want you to act. Okay, that's 3-year underperformance. Anyway, so why do these underperform? Well, the reason they underperform is if you're Fidelity or a St. James's Place, you have got billions under management. Why? Not because you're good, but because you've got a distribution network through Hargreaves Lansdown, okay, who'll sell you any shit because they get commissions, right? So there's conflict of interest in finance. In case you didn't know, there's a lot of conflict of interest in finance. And what's going to happen is once you've got those billions, you're going to say, crap, we've got a load of money. What are we going to do with it? Well, we better create an Asia fund. We better create an environmental fund. So you'll create by geography theme, okay? So it'll be US, UK, Europe, then themes, AI, environment, whatever SEO keywords are great. And then you'll say to those individual 20-something fund managers, listen, guys, we're going to pay you a bit of money out of the fees that we charge. But you can only pick from, say, the UK. So you've got a narrow list. Well, why should that be your problem in your pension? Because in your pension, you want something bespoke, presumably. You want something today for your risk appetite, not a fund which had bought a load of stocks that you've now inherited, which they might sell tomorrow morning because the market's going to fall and they're never going to tell you, sell my fund. Has an IFA ever told you sell this fund manager's fund? Of course not, because they don't get fees if they tell you that. And those funds can't hold cash. In a falling market, they can't hold cash. So whereas I can tell people, because I don't have a conflict of interest with them, I have zero conflict of interest with them. So whereas I can tell people in 2022, January 2022, I can't find something great in this month's Excel spreadsheet. Let's wait till February to find something. Then in February, I tell them can't find something in February. Let's wait till March. Let's wait till April. And we end up holding cash the whole year. Well, thankfully we did, because the market fell and we didn't know it was going to fall that much or at all. We just said, can't find something interesting. That's all. We don't overpredict. I don't overpredict. Okay. So the point is that you don't have the problem of having billions under management, sadly. You need to pick your 20 to 40 stocks, your 5 to 10 exchange traded funds, i.e. low volatility index tracking funds based on your risk appetite. And we'll come to that a little bit later as well. You don't need to be paying for their kids' school fees and getting this shitty return. So we're going to address that issue as well. We're also in this webinar going to discuss, well, what's the smart money saying in terms of investment ideas for 2025? What are they saying? You can take a picture of this if you wish. Okay, what are they saying about their various investment ideas? And I'll talk about some of these things. Okay, what do they like? How much do they like it? And so on. So we will come to some of these broader ideas. Where I might disagree with them, I'm not going to necessarily go into too much depth. I mean, you don't really care about mergers and acquisitions, other than to know Goldman Sachs would benefit from that, and so would JP Morgan. But we'll talk a bit about Goldman Sachs and some of the money and what the big investment ideas are. Also implied in what I'm going to talk to you about today is UBS rich clients get Goldman PIMCO strategy with no extra fees. As a hedge fund manager, you get a lot of stuff crossing your desk, and insights which aren't available to private investors, which I think they should be. Okay, because it's education and information, which is the point of this webinar. This is not saying to you, go out and buy this. This is not a solicitation to buy and sell any individual security. Okay, it's not individual financial advice. I'm not talking to you individually. I'm trying to educate you. So when I come across UBS rich client strategies, I want to share them with you because, well, call me Robin Hood or call me divisive or anything. That's why I want to share it, because I don't think that's right. I grew up in Armley, and there were enough rich people which would stop you from getting ahead in the world. Then I don't want to be one of those people who stops you. So I think education is probably the quickest way to share that information. If you don't want to use that information, that's perfectly fine. But I think it's important to share that education and information with data, with hard data. Data. That's my background. I mean, you know, as a visiting fellow at Oxford, I lecture on it. You've got to be pretty data rich on when you're doing that kind of stuff. US markets outperformance is justified by higher earnings growth. Now, yes, the markets in America, for instance, are overvalued. We'll look at UK markets in a second. Okay, but there is US equity performance versus rest of the world, 2010 to 2024. Now, this is the US, this is everybody else. And you can be in the rest of the world all you want and talk about how brilliant it is. I wrote my very first column in the Financial Times in 1999. I'm switching to US stocks, 1999, quarter of a century ago, and it's worked out okay. Okay, as you can imagine, half a lifetime ago for me, quarter of a century ago, I said, I'm switching to US. I'll show you the article in the Financial Times where I said it. It was my first column in the Financial Times, and it's worked out all right. What's happening right now is, as long as profits grow. Now, when I was doing my Bloomberg TV show in the dot-com bubble era, we knew for sure it was going to burst at some point, but we knew to jump off before because the earnings weren't happening. And I'd say to Sally on the show, Sally, earnings aren't happening. If earnings aren't happening, you've got a problem. Okay, at the moment, as long as keep a close eye on earnings, and that's what I do, and I do my weekly updates and the like, I keep a very close eye on earnings. As long as the earnings keep happening, then we're okay. Okay, as long as those earnings, and we'll look at that more so. Now, the S&P, for instance, which is the 500 largest American companies, it's just an index of, or a collection or a basket of the 500 largest US companies. 20% gains last year, this year. What happens in year three? Well, historically, you get a pretty good year three as well. Not guaranteed, but you do. We'll worry this time next year what happens if you get 3 years of 20% plus gains. Doesn't look so good the year after, which would be 2026 in this case. But anyway, So I'm not too worried about that. By the way, I will sprinkle in this, if I haven't already, some self-promotion. That happened today. Oh no, wait a minute, achieved 22nd. I tell a lie, it happened yesterday. I saw the email today. That is from YouTube. I don't know if you can see the writing at the back as well. Yay. So they sent that. So that's good. So the education's working. I want to try and get to 1 million people, teach 1 million people how to add 1 million to their portfolios across their lifetimes, because 1 million times 1 million is 1 trillion. And that's a pretty good thing to do. Now, where are we also for today? This. Now, this is one of the reasons why at the moment there is a massive, stark divergence between the UK and the US, probably the widest I can remember since probably pre-1980, and I don't remember anything pre-1980 anyway, other than from the history books. So in the 1980s, when I first started investing, buying BT and all the rest of it, and you had Reagan, that was fine. There was a similarity in economic policy. If you remember, it was monetary policy, and both were quite loose, and that was fine. We haven't got that anymore. Now you've got this divergence. Your pension, which is going to be predominantly UK based, is more like, don't take my word for any of this. I'm just going to give you a conclusion based upon the data. You might come to a different conclusion, but at least you're going to get my data. And the data that I have for you is this: UK GDP unexpectedly flat. Well, it's not bloody unexpected. You have to be a bloody moron to think that's unexpected, for a very simple reason. If you raise taxes on employment through national insurance, okay, and inheritance tax, then and you say corporation tax is going to stay at 25% for the next 5 years, so you think you're giving stability. You're not. You just told me you're going to punish me for 5 years. You're not going to move it back down to 19%. Then what the hell do you think is going to happen? Well, there's only 3 types of spending that goes into economic growth. Consumption from the private individual, well, that's slowed down because the consumer's thinking, shit, they're not going to be hiring much. And looks like inflation's not exactly collapsing either, and interest rates aren't moving down as quickly as we thought. So the consumer's thinking, I'll hold off. The only bloody place the consumers are spending is abroad. They bugger off on their holidays and then they go and spend it in Dubai or something. Well, that doesn't help Britain anyway. Thanks a lot, guys, all you traveling. The ones who've got enough money to travel are spending it abroad and helping other people's countries. And we're not exactly saying we want people touristing over here, are we? Now, consumption. So that's the problem with consumption. Okay, let alone you just told me taxes are going to remain high, such as inheritance tax. Then you've got corporate investment. Well, you just told me corporation tax is going to stay at 25%. You've just put employer national insurance higher. So I'm hardly about to start saying, right, let's spray the money and invest. Whoa. And the third one's government spending. Well, you've made that bloody clear that you're bankrupt. So I know government spending's not coming, and you're telling me it's unexpected, that GDP flatline. No, we're getting a recession next year, which is 2 negative quarters of 2 negative GDP quarters. In other words, declining GDP over 2 quarters. Yeah, you're getting that. Of course, you're bloody getting that. This is the Telegraph. This worried me. Britain's state pension Ponzi scheme faces a catastrophic collapse. That's not me. That's the Telegraph. Government debt is at £2.8 trillion. Britain is sleepwalking financial Armageddon. No government. The state financial system is a big Ponzi scheme. What they're talking about is this: as long as I'm earning money and paying tax, I'm paying for people as they get older to receive their state benefits. The problem is the state is paying too much in pensions, and there's not collecting enough from young people in tax. And we used to be able to make that gap by having population growth, by basically people having kids, having them early, and immigrants. Well, we're definitely trying to cut back on immigrants. We're definitely having kids later. We're having fewer kids as well. So who the hell's going to pay for grandma and grandpa's pension? That's what they're talking about. So all I know is I'm saving for my son now. Okay, back in the day, my parents wouldn't be in a position to save for a 6-year-old when I was 6. Now, yeah. How much do I need to save? As much as possible, and make it grow as much as possible. That's the answer. Don't try and work it out to the 5th degree of, it should be 1%, 2%, or whatever. Okay, either. So we'll look at that as well. Raj, I'll answer your question in a second. How would a customer achieve this given they pick their own stocks? I don't know if they pick their own stocks, how they do it. That's up to them, how they do it. But what I show them is how to do it. So if they're doing it themselves, God knows, they'll probably throw darts at a dart board, or they read a magazine, or they give it to a fund manager. But for me, it's relatively straightforward. I need these all to be 5. All these to be green, because those are the cherry-picked companies. And my target isn't the S&P, it's too low as a return base. Although last 2 years it's been great, but generally I need a higher return than the S&P 500 would give, because if you think about it, it's 500 companies. Some of them are pretty poor. Why would I want to try and compete with something which has a bunch of poor companies in it? Last 2 years have been good, and probably the easiest way to beat it, and the simplest way, which if you follow me, you'll know, I have 3 times leverage S&P 500 and now 2 times leverage S&P 500. There you go. It's easily beaten. I can do 2 or 3 times better. That's not rocket science, is it? And you leave out the companies which are underperforming, expensive, low growth ones with poor cash returns. Poor companies, leave them out. Pretty straightforward. Okay, so there you go. And if you don't even want to go into that level of complexity, as I said, we just do a simple leverage on it and beats it, because it tends to go up rather than fall. And I'll show you the data on that in a second. This is Sunday Times. £260 billion wiped from valuation of assets in pension schemes. That's not me. That's just what's getting wiped out. So your pension's getting wiped out. We need it to work harder. I think I've made my case. This is one of the emails I got just this month. The education that you provide is also becoming evident in my portfolio performance. I started the Great Investment Program in March, didn't start investing with my ISA till April, which is currently up 6.3. And I started with a SIP in June, and this is up nearly 13%. Didn't get that over blah, blah, blah. I didn't get that over 3 years with an IFA. So this was a low risk person. Remember, not everybody is trying to get the same performance. Some want less volatility and they're happy with whatever they're happy with, but didn't get that over 3 years. We did it in 6 months. Good. Contrast that with 6 months with the Great Investments Program. This is the goal, to educate people, but 6 months is too short a period on which to judge anything. We're not trying to be smarter than anybody else. What we're saying is we look at the data and we look for companies which are undervalued and growing. And if somebody doesn't want to do that, they can just have an index tracker. And there's better ones than the S&P to track indices. And I'll tell you why there's better ones than that you can track, because there are ones which generally year after year go up more and have less downside volatility. How do you know that, Alpesh? Well, here's a whole list of index trackers, because we look at the data and we go through 8,600 of these, and then we say to ourselves, okay, which ones of these are giving a better return, lower and consistent and higher consistency of return with high sortinos, in other words, going up a lot more and outperforming the S&P over a consistently long period of time. So there are other choices beyond that. People obsess about the S&P because they've heard of it. But actually, what if you can get other index trackers which do even better? Suited to your risk appetite. It's really important to work out. If you want low volatility, it doesn't mean you're going to get lower return. It means you're going to have less choice. And that's fine, because you don't need something of everything. And that's the problem people have. They think, oh, low volatility means low returns. Therefore, I must take higher risk. Well, you can take high risk by crossing the road tomorrow with your eyes closed. Have you got a better return? Did you get across the road quicker? No. You're dead. So high risk doesn't mean better return. It just means high bloody risk. Low risk, low volatility. What do I mean by volatility? What I mean is fewer of these drops, okay, and quicker recoveries. So we ideally want a company which, worst case, goes up like this, but worst case, if it has falls, they're shallow and they recover quickly. Well, we cheat. We cheat. How do we find those? We cheat. We don't just look at their balance sheet, profit and loss, cash flow statements to make sure. And by the way, the companies that tend to do this tend to be ones with good cash flow, good profits, low share price for the profits they're generating. So every time the share price goes up, the profits go up even more. Good cash flows. What we do by cheating is we look at something called the Sortino ratio, which is just a mathematical measure of the stock price. It just looks at the average price over periods of time and the volatility or risk of missing it. If you remember your maths, it's the mean versus the standard deviation. Okay, we just want a high mean and a low standard deviation from the mean. That's it. Standard deviation to the downside. That's it. That's Sortino. That's from the hedge fund industry. And I learned that before 2004, and we just cheated and copied that. A lot of what we do is simply cheating. We don't try and think, oh, what's the future of AI? No, that's hard work. That's complicated. What we do is we say, which companies have consistently high Sortinos? Bloody obvious, I know. Deutsche Bank sees S&P rising 70%. They're probably wrong. I'll tell you why they're wrong, because banks tend to be wrong, but that's what they think. That's what they're... Now, whether they're right or wrong, I do not know. What I do know is I expect my pension to go up by a third over the next 2 years. Next year might be a down year. I don't know. But I think over 2 years, we'll be up about 32%. Why? I'm going to show you some compelling evidence why I think I'm right. I can't guarantee it, that that'll happen to my pension, but I'll show you some compelling evidence why in a second. The 4 new things which people really love this year, given that it's end of the year and we're looking back: exchange traded funds. What we showed people is that there's a whole basket of stocks, funds, exchange traded funds. I wrote about these in the FT. You buy these in your SIP or ISA like any other stock, where if we can project forward the trend and we look at their Sortino, high average return versus low downside risk, and we look at the other factors around them, and if we can get a projection, which not guaranteed to, but were to continue on the same trajectory, give us a 40% return, where it would be reasonable to put a 20% exit if it were to drop, because if it's going to go at 40, it shouldn't drop 20. If we can see that, then we'll have lower volatility, less risk, and a better return. We also looked at, and I'll show you these in a second, hedge funds to see which hedge funds are generating 40% per annum per year for the last 3 years. So 40% on average every year for the last 3 years. And what do they currently hold? And is anything that they hold, and this is the bit people don't hear, is anything that they hold also on our filters? Is it on our filters? So does it meet all our criteria? If it does, then we'll have a deeper look at it and then decide whether or not, yeah, that's worthy. Okay, but everything has to be bespoke to each individual client's risk profile. Some will say, oh, I'm an 8 risk, I really want more. Others will say, no, listen, I'm 5, I'm 60, I'm retired, I've just sold my business, I'm a time poor professional, give me simple. Others will say, hey, listen, I'm 35, I'm an accountant, got a bit of extra money coming in all the time, I want a bit more risk. So we'll base that and give them the stocks. Well, we'll give them all the data, but then they'll select the stocks based upon their appetite and process. Okay, I'm going to answer the questions. Do keep them coming. I'll answer them either as we go along or at the end. The end goal is that's proved really positive for people. They really like we're still looking at the same Excel spreadsheet of value, growth, income, cash flow, Sortino. But because we've cross-referenced it with hedge funds, let's say, and the 40%, people have found it more interesting, which is great. I mean, I love it. Okay. This is more like mentoring and certainly great. I love it because when we get that feedback, we know we want to do it. This is what the Dow looks like. This is what the NASDAQ looks like. This is what the S&P looks like, okay, over a number of years. My job is very simple, okay? In many ways, my job, if nothing else, I could simplify and say, if you're one of those people who say, listen, Alpesh, I haven't got time for any of this. I haven't got time for any of this. Then my one job I've got to do for you is to avoid 2022, okay? And I've told people time and again, including go to my YouTube videos, and one of the reasons why I've got this on YouTube, from YouTube, is because of that. In January 2022, when I kept saying, and in February and in March, saying, well, we're still not finding anything we want to buy, okay? My job is to at least keep you out of that. Now, if I said to you, forget me, ignore me, assume I'm rubbish, okay? Let's say you just got those returns without that. And I'll come to the minus 33 in a second. All these without that, you'd probably say, you know what, Alpesh, that'll do. Thank you, mate. Job done. Forget individual stocks. Just forget that for a second. That's all you got, right? Well, as you will remember from January 2022, and it happens once every 7 years where I have to say to students, stay in cash, because we look at, this is the average prices. We look to see if medium and short-term average prices, that's what this is measuring, are falling. If they're falling as they are there, we stay out. Now, I could say to you, oh no, it's because I was awfully clever and I knew in 2022 that the market was going to fall. That isn't true. All we knew is medium and average prices are falling and we want to get the hell out. That's what that measures, okay? And we want to hold cash until they're rising again, which didn't happen basically until January 2023, hence the NVIDIA purchase then and all the rest of it. Okay, now that's all That didn't just happen here. It happened across a load of stocks. That's how we knew, let's just stay out of the market and hold cash. We didn't know how much it was going to fall. We didn't overpredict. We didn't know it was going to fall 25%. We didn't know it would have to be for the whole of the year. All it was in January, I said, let's wait till February. February, I said, We looked at the data again in February, I said, no, March, because we look at it monthly. March, we said April. April, we said, let's wait till May. May, we had a few energy, I think it was May or July. July, we had some energy stocks because of Ukraine and all the rest of it. But my point is, that isn't actually that complicated. It wasn't seeing into the future. Also, if I said to you, it's because I'm awfully clever, I knew that was going to happen because I knew macroeconomics, because I've got a degree in economics from the world's #1 university, you'd say, bullshit, that's not the reason why you knew, because we've read your books and you've said for 25 years in your books when you exit. Oops, I have. So I couldn't tell you I was awfully clever, even if I wanted to, because I've already written in my books how I exit. I'll make sure you get a copy of the books. Let's see if we do that right now. Actually, make sure you get a copy of Investing Unplugged so you can see it all. There you go. Free copy of Investing Unplugged should pop up somewhere on your screens so you can download the file. Okay. So my job is to avoid that, if nothing else. Now think about how low a hurdle I've set myself. Of course, what I really want to do for my son and my wife is get a better return than this, is to pick some individual stocks, but I don't have to if I don't want to. As I say to my wife, I don't ever want to work again. I don't have to work again. All I'll do is wait once every 7 years and make sure those years we stay out, because the rest of the years are pretty bloody good. And darling, if you don't get 40%, but you get 24%, i.e. this, you'll be happy. Or 2023, you get 24%, you'll be happy, sweetheart. And she goes, I know no better, Alpesh. You're a wonderful husband. Of course I'll be happy with even 16%, God help us. Why do I do leverage on funds, on exchange trade funds? Well, because statistically that happens and that keeps me out. Anyway, we'll go into some of that. It's not all roses with individual stocks. Look at this. I always used to joke, well, of course, Trump could come in, do a tweet, and a stock could rise or fall. Well, CVS was one of ours. The data showed all looks fine. It tanked. Not least because Trump does a tweet. There is no Excel spreadsheet. Now, if that were to scare an individual, oh my God, individual stocks are more volatile. Very simple answer. So if you think individual stocks are more volatile for you, you're not obliged to have them. You can have exchange trade funds, which are index trackers, anyway, with lower volatility. You just look at this volatility number, okay? And as such, you would just avoid, okay, you would avoid the higher volatility ones. Okay, so if you go to a CVS, wait a minute, that's not the right CVS. We've got to make sure we find the right CVS. You would make sure it's not the bloody vet in the UK, CVS Health. Okay, you avoid the more volatile ones. Anything with 29, 38, no, anything in pink. And look at how volatile so many of the pink is like a red alert. Okay, look at how many are just ridiculously red. Look at those pinks. You want to avoid those because you don't like individual stock volatility. You're better off. I want you to look at those volatility numbers. I'm going to show you exchange trade funds. You'd be better off in exchange trade funds. We work out what your volatility is, what your volatility appetite is. Okay, Broadcom passed $1 trillion in AI sales. I did another cheat on this. Do you know what I did? And I might do this again tomorrow or something. At the start of the year, I looked at all the stocks which were near $1 trillion valuation. And then I listed which ones are going to cross the trillion, which were the ones which were just outside the trillion during the course of the year. And obviously Broadcom was that. I mean, that's stupid. Okay, but we also made sure value, growth, income, cash flow, Sortino. And then we said, you know what, the market's going to drag this above $1 trillion because the market likes round numbers. So Broadcom, yeah, it ticks numbers, but it was from last year and it was AI. I can't take credit for it. It was AI. We just happened to use it for that as a bit of fun, which turned out to be bloody ridiculously good. Investors pour $140 billion into US stock funds after Trump victory. Yep, that's right. That is putting up the dollar because foreigners buying US stocks. Okay. The media hates him. All right. The media hates Donald Trump. Mainstream media hates him. They like to sneer, whether it's CNN or whoever, they like to sneer. we look at the money. We don't look at narrative. We look at the money. The money's going in. That's pushing up the dollar against other currencies. Okay. So when he puts taxes on imports, those imports are already cheaper because the dollar's gone up. So those taxes have net no effect on those imports, those import tariffs, right? But the media won't tell you that because they just hate him too much. They're biased. They're blinded by their hatred. So who's paying those taxes? Actually, the foreigners effectively are, because the dollar's gone up. Okay. The guy is, as a businessman, think of what a business is. Is a business a democracy? Is it hell? Where you work in your business, are you working in a democracy? Do you have votes to pick your CEO every 3 or 4 years? Do you? Hell, you get told what to do and you bloody well do it, don't you? That's what a business is. He's running this. I'll tell you, the latest person he's just hired as his policy advisor is somebody my wife knows, Srinavan Krishnan. He's appointed him as his AI policy advisor. Let me give you some insights. None of this is confidential. My wife spoke to him a couple of weeks ago before that. Srinavan worked at Andreessen Horowitz. Andreessen Horowitz is one of the leading Silicon Valley venture capital firms. That my wife's in venture capital, so she deals with them a lot. And they are very pro-Trump and they're very pro-crypto. Okay? I want to avoid saying that word because if you say that word on social media, you get banned. Not Trump, the other word. Okay? And his AI guy, when it comes to AI policy, let me tell you what's going to happen. It is going to be libertarian. It's going to be do whatever the hell you want, pretty much. Okay? And when it comes to crypto, there is nobody more buoyant, bullish about crypto than Andreessen Horowitz. They're the people who funded Ripple, XRP, which I bought off the back of that and was underwater for 5 years until Trump came in, and then it shot up 250%, which I didn't know was going to happen. Look at how often I say I didn't know it was going to happen, because I didn't know it was going to happen. I can't guarantee the future. I don't have a crystal ball. All I do is position myself to be in a position to get lucky if there's a tailwind. If there's no tailwinds ever again, I'll never be lucky ever again. All right, you can call it luck if you wish, but we just look at the data. That's all we're doing. Juan, can you show the data where you and your clients beat the US indices? Consider. Yeah, Juan, if you message Paresh, he'll show you all the data from 2004 for both us and the clients, where we just consistently beat the US indices. So Paresh at tradermind.com, and he'll give you all the data and take you through it from 2004, from 20 years ago, because it's been independently audited by a Financial Times award-winning financial services company. So Paresh at tradermind.com will do that for you. Hossam, I don't know. I hope so. S&P is on track for back-to-back 20% yearly gains, as I said, and we should have it again. Juan, if you can't be bothered doing that, it's really simple. Just do 2 times leverage S&P, and then you'll have beaten it consistently. It's really not rocket science. Okay, I showed you the data. Just do it yourself if you can't be bothered to look at our data. But yeah, if you email Paresh at tradermind.com, he'll take you through it all for every single year, and what we bought and why, and the independent third party, the Financial Times award-winning company, which will provide you that as well, so you can cross-reference it with them as well, because they've done it in real time, not historic, not back-tested. They did it for the last 20 years with me, ever since I set up the fund. Investors rush into US equities. That's what's going in. That money is causing the markets to rise. There's no 2 ways about it. US enthusiasm contrasts with outflows elsewhere. The money from around the world is going there. Now, this doesn't mean Western Europe and Japan and China, if you can believe their data, good luck to you, and emerging markets won't do well. They might do well. They might, you can bottom fish and they might jump up a bit. China should hopefully come around. I was lecturing at the University of International Business the day after 9/11 in Beijing, and the perspective from Beijing is very different from the West. They obviously couldn't care less about the Twin Towers and what it meant for America. Why should they? They're in the other half of the world. What they cared about was, what does this mean for their entry into the WTO? If you remember, there were there'd been the GATT round of trade talks, and they were supposed to enter the WTO around that time. and what it would mean for growth. So different things are important for different countries. In China, it's growth, getting out of poverty, and those are the two most, and social stability, okay? Social order. Social order. Now, we don't have a worry about social order so much in the West, okay? We care more about inflation in the UK and in Germany than we do about growth. In America, they care more about growth and probably less about social order generally, okay? So different things matter to different countries. And the Chinese at the moment are trying to get that growth. They're having difficulties, but they'll probably get round to it slowly. But the Americans are having no problems with growth this year or next. No problems at all. Okay. Hossam, it's a hedge fund. It's not open to retail clients. We take institution money only. That's the law, unfortunately. And I have no plans to have a retail fund for a very simple reason. If I have a retail fund, I have a conflict of interest with you. In a down year, I'd have to say to you, keep your money with me, when I should be honestly saying, hold cash. So the whole point is, why don't you manage your own money instead of paying me fees? Why do you want to pay me fees for the rest of your life? Okay. Why? So the benefit of having a hedge fund is you're only by law allowed to have institutional money. So Aegon, AXA are investors, for instance, family offices. So the founder of New Look was one of my first investors in 2004. New Look, the high street chain. So it's that size. Why? Because they write bigger checks, which makes it worth your while. Whereas with retail funds, the problem is you write smaller checks, and I'm never going to tell you not to take your money back in a year like 2022. Why would I tell you in 2022 if I've got a retail fund, oh, don't give me fees this year? I'd have a conflict of interest with you, wouldn't I? And then my reputation would go down the toilet because I'd be saying, no, hold on, don't worry, keep paying me fees. Alpesh, you just lost me 25% that year. Thanks a lot. Yeah, I'd sell my reputation. That's why you don't know the names of any bloody fund managers, because they know they're going to screw you sooner or later on those down years, and they don't want you to know their names. Okay, that's why. Now, this is useful. This is what I want you to do. What I want to teach you is take a copy of this. What I want you to do is always look at the max drawdown and the max loss. Okay, now what's max drawdown? Max drawdown for any stock you might own. Keep a little Excel spreadsheet, please. And the drawdown is you're just going to look historically, whatever it might be. I've given some examples there. Okay, let's look at Apple. All right. What you're going to do for your own sake, you're doing this yourself. Okay, don't give me your money. I don't want to manage your money. I want you to manage it. That's the point of this webinar. I want to show you how to do it. If you don't want to do it and you want to give your money to an IFA or Hargreaves Lansdown or a fund manager at St. James's Place, then you're in the wrong place. Go to them, give them your money away and pay them fees and pay for their kids to go through private school. Please be my guest. I think it's a shame. You won't make money. They will. Transfer of wealth. That's how it works. But I want you to know how to do it. You keep your money in your account. And let's say you are looking at, for argument's sake, an Apple. What I mean by drawdown, and this is free, by the way. I'm not affiliated to TrendSpider. You can look at TrendSpider or TradingView or Yahoo Charts. They're all free. Okay, I mean, you can pay for them, but you don't have to. You can get enough for free. Okay, and I'll try and give you things for free where I can, like my book, for free. Okay, so you look at that fall. And that's what I mean by drawdown, from a peak to trough. Now, if you're not comfortable with that kind of drop over that period of time, then don't have individual stocks, have baskets of stocks. Okay, it's as simple as that. That's it. Now, you can't have it both ways. You can't say, well, I want great returns, but never any downside. Because if that exists, I'll let you know, because I haven't found a stock which gives great returns, but never any downside. Okay, never any volatility. But I want you to monitor things to that standard. I'm going to share with you the caliber and what the bar is and what I want you to do. This is Wells Fargo, not me. This is Wells Fargo. Do I agree with them? I don't know. I don't know. I'm going to come to the S&P 500 in a second. I don't know if it's going to go that way. Now, listen to me. Let me say that again. I don't know. What I know is I continue holding what I've got, which I'll come to in a second, because I've only got 3 decisions to make: buy more, hold, or sell. Okay, so I'm not selling what I've got at the moment because I don't need to make that decision today. So why should I make it? The only decision at the moment is, well, I'll continue holding it because things are going in the right direction. I haven't got a sell alert. That's it. People try and over-predict and say, well, I think in 6 months things are going to fall, so I won't do it today. They don't think straight because they don't have the experience or the expertise on the right questions to ask and actually what they should be asking and thinking about this, okay? This is the flip side. London's stock market shrinks at fastest pace in over a decade. I was there 2 weeks ago for a meeting, and yeah, we know where the money's going. That doesn't mean we don't look at UK stocks. We've got the data on UK stocks as well. And I can tell you there's very, very few, unfortunately, out of the UK which meet our criteria. Okay, I'll show you all the ones which don't. None of these, and this is the 250 largest, FTSE 250 largest UK companies meet all our criteria. That doesn't mean they can't go up. Look, some of them, okay, which ones have gone up in the last 6 months? Look, that one went up. See, some of them can go up even if they don't meet our criteria. It doesn't mean they can't. It's just that probably less bloody likely to. That's all. Whereas with all green, we think there's an increased probability, but not a certainty. If you're looking for certainty, you're in the wrong place. The stock market is the wrong place. Okay. Watch that film. It's Christmas. You've got some time. Watch The Big Short. Very good film. Aaron Sorkin wrote it. That's why. It's a really good film. That's me trying to do my Michael Burry bit. He's one of the hedge fund managers who looked at the data and saw the financial crisis. Now, just so you know, I didn't see the financial crisis. What I saw was, okay, we don't have enough picks this month. Let's wait. And then it was like, bloody hell, market's falling. I'm not even going to buy in this. Our approach is different. We don't look at mortgage default rates in the Midwest and say, why are they handing out so many, the way Michael Burry does. We just, well, first of all, I don't have his brain power. What we do is look at something different, which is we look at this data and say, is there anything worth buying? That's a different question, but it gives you the same results effectively. Okay. Oh, by the way, well, in a way it doesn't actually. Let me tell you what happens. So when the markets fall, and somebody asked me this really clever question last time. They said, so do you go short? No, we don't. When the market falls, we're happy with a 0% year that year. Just so you know. Alpesh, does that mean you do better than, does that mean you make money every year? No. That year when the market fell, we just ended up holding cash. Why don't you go short? Well, because it's investing, not trading. On trading, we can do whatever we want. That's a different story. Minus 20%. Okay, actually, worst case, the market fell 26%. We didn't short that. Oh, you idiot, you should have shorted it. Well, that's a trading discussion. I've given videos on that. It's a separate issue. But on the investment side, we don't short. We just wait until we find something worth buying. If we don't find something worth buying, we don't buy it. A bit like Warren Buffett, loads of cash on the sidelines. 1 year in 7, you're going to have a lot of cash on the sidelines. By the way, this whole thing, I mean, look at this, stock holding accounts in India. There are now 179 million. This is data from Bloomberg. If you want one website recommendation, Bloomberg.com is it. I mean, I'm biased, conflict of interest, raise my hand. For 3 years, I was presenting my own shows on Bloomberg TV. So I know it from the inside. It's phenomenal. 179 million. That's the number of accounts, stock holding accounts held by individuals. That's, what is that? Double the population of the United Kingdom. Okay, so it's 2 accounts for every man, woman, and child in the United Kingdom. Stock accounts. Amazing. Annual S&P 500 index returns, 2000 to 2024. So I'm not getting a good pension return. I'm not getting it. The market's getting it for me. Okay. I didn't invent the stocks we invest in or the funds we invest in. I ride the coattails of cleverer people. Okay. This is again what people get wrong. I am not overstating. Peter, you're absolutely right. You need 0.5. You're absolutely right, actually. I didn't think of that. I should just focus on educating Indians instead. I do get the third most so the 3 most on data analytics on YouTube, the 3 most popular countries for watching my content are United Kingdom, United States, India. And then after that, in close contention is Canada, South Africa, and then I think Middle East and so on. So India are the third most popular, but my focus is really the UK, because I think the pension crisis in the UK is pretty bad. You might say, well, the Indians need you even more. Why don't you go back? But that's a separate story. You wouldn't say that. Counter value less than P500 index return 20 to 24. Well, 5 years you get more than 25% return. I don't do that. The market does that for me. If there's a tailwind, we will do well, because there's a tailwind. If there's a headwind, we won't do well. In these years, okay, in those 3 years, we'll end up holding cash and getting a 0%. We might even not go into cash quick enough and might get a slightly negative return. My job is, if it's nothing other than just even to match the index in these years, is just to make sure, actually, even in these years, let's say I match the index in those years, is just to make sure in those 6 years, we don't lose too much. Okay, so we hold cash as quickly as possible. That's it. In one sense, that's my job. Or as my wife puts it, you're at an age, Alpesh, with whatever you've done and achieved and accumulated, don't F it up. That's the don't F it up bit. What people try and do is be too smart ass and say, well, I don't want 25%. I want 100%, and I want the stock that's going to deliver it for me. Give me the secret stock. And some guy in a magazine or internet will say to you, oh, we found the next big thing in nuclear fusion meeting quantum computing. Buy this tiny little penny stock. And then they don't do it and they go, oh, I messed it up. Okay, there's a lot of idiotic people out there who are just waiting for somebody to rip them off with stupidity. My job, actually, in one sense, is not to F it up and make sure whenever these years happen, I get to cash as quickly as possible. That's one way to look at my job. How simple is that? Whereas people are trying to overstate it and say, oh, no, you can see into the future. They want to ascribe to me that I can't see into the future. I didn't even know AI was going to be a big thing. Was it last year? Yeah, about end of last year. Why didn't I know that? Well, because they've been bloody talking about it for 30 years. Steven Spielberg did a film in the 1980s on AI. Been waiting for ages. Who knew it was suddenly going to take off? Of course I didn't know. My son's junior high, so this is historic. Don't look at these picks today. These aren't for today, although we do rely on Globant now and again, in and out. Apple pretty much held since then. Premier All's long gone. Okay, my job with his portfolio is, I keep it simple. People ask me, does he mirror yours? No, he has about 6 holdings in it, because I can't be bothered looking at his. He's only 6 now. Okay, although I joined in 2021, I only really got deep into investing when I was weekly around 15 months ago. Seen returns of over 60%, so going really well. The lifetime membership was always key for me. Busy running my own business. Now, we get a lot of people running businesses who say, I'm time poor, or professionals, I'm time poor. The process, the answer to them isn't give it to a fund manager on IFA or St. James's Place. The answer is, let's find a simple process for you whereby you've got the data and you only need to monitor your holdings on your own app with your own broker once a fortnight. So you can continue running your business and don't have to worry about your portfolio. Because people go, oh, can't you run it for me? Can't you run it for me? Mate, who cares about your money more, me or you? Who do you think? You do. What, can you not be bothered to look at your pension on your phone once a fortnight? Can you not be bothered? If you can't be bothered, then you don't deserve a pension. Okay? If you can't be bothered, right? No. I'd rather give it to an IFA and pay his son's private school fees. Here, take my money. Take my money off me, please, because I haven't got 5 minutes to look at my own pension. What is wrong with you? Okay, it's your money. Sorry, I'm talking to you parentally, but it does strike me as somewhat odd. So what we do with people is make sure we've got a process where they've got the data. We say, okay, here are the stocks suited to your risk personality. Monitor every 2 weeks, make sure they don't drop. Can't you monitor it for me? How bloody lazy do you have to be not to monitor? On a phone, they make it easy. The brokers do. Whether it's a free trade, Barclays, Hargreaves Lansdown, AJ Bell, who else can I think of? Interactive brokers, interactive investors, they all make it bloody easy for you because they have to legally. Okay. So here we go. That was the article. That was one of the articles. Okay. That's me in the Financial Times, my diary. So I keep a weekly diary of my investing and so on, and telling people about the markets and what I'm doing and how I was doing it for 5 years. So there's 200 columns in the Financial Times published, the diary of an internet trader, explaining all of this. So I'm just taking the best practice from those years and giving that to you now. on it. Okay, I'm going to go through the S&P and stuff. I've taken too long already to do that, so I'm going to try and do it quickly because it's getting late for everyone. Alpesh, sorry, hardly been in touch since joining the Great Investment Program 2021. I started with 100K in 2021. Rocky start. Yeah, I get that a lot because when you first start, you don't know if the market's going to go up or down in the next month, 2 months, 3 months. Today have 400,000, basically 397,000. He's added a little bit into that. Okay, that's the idea. That whether you're busy with kids, because everybody's busy, but what I'm trying to get across to people is, please, for the love of God, do not think that, oh, I'm busy running a company or I've got kids. That's why I wanted to show you those 2 emails. Therefore, I can't look at my pension, because actually you've got the example of people who can, who found the time to do it, and the benefits are better. And all they have to do is for 5 minutes, just check, has anything been dropping over the last over the last 2 weeks? Okay. That's all. You look at this and you go, okay, that's it. It's as if they think it's rocket science. It isn't rocket science because we've done all the hard work for you. We are glorified plumbers. You don't do your own plumbing, do you? You call me in, here's the data, and we not just dump you with a load of data, we'll show you, right, you want all these to be green. These are the maximum drawdowns. You don't want to draw down more than 10% because you're risk averse, or more than 20% because you're more risk loving. Here's the ones. We're not saying these are going to go, we've got some secret inside information. We haven't. Okay, Deutsche Bank sees S&P. I said that already on that. There's some positivity. I don't know whether the market's going to go down or up next year. What I think is over the next 2 years, I should be up 32%. And I'll tell you why in a second. This, by the way, for those who are depressed, the Dow 30 companies, the companies which are in the Dow, and how they did during the last crash when the markets fell in the financial crisis of 2008. In 2008, this is how they fell. Now, the reason I'm showing you this is this. How many went up? Okay, barely anything. McDonald's went up. We didn't own it. Amgen went up. We didn't own it. Walmart went up. We didn't own it. Now, in hindsight, you might say, oh, I know why. The reason I show you this is for 2 things. When the market's falling, like in 2008, I'm not going to buy anything, right? Even a McDonald's. Why? Well, for flipping heck's sake, everything's falling, and you think I'm going to be the idiot going, yeah, buy some McDonald's, guys. Everybody needs to eat cheaper food because they're all going bankrupt. No, I'm not going to say that. I'm going to say, well, it's going up, but you got bigger balls than I have if you're going to go buy McDonald's when everything else is raining a complete shitstorm. Okay, so that's point number 1. Point number 2, what happened to diversification? You've been told a lot of lies. You've been told diversify because you'll be protected against market falls. No, when the market falls like there, notice how everything's red. How come everything's red? Okay, how come 3M, what do they bloody make? Stickers? And Caterpillar have both fallen pretty much the same amount. Because I've written about this in my Financial Times column. When the markets fall, everything is correlated to the downside. Everything's correlated to the downside. That's why. Okay, when the markets fall, right? So you don't get the diversification you wanted. You have to be holding cash, i.e. get out of the whole bloody asset class. No IFA or fund manager will ever tell you that. You know how to beat the S&P 500? Make sure you know when to bloody hold cash. That's how. Because that'll make your performance look stinkingly freaking amazing. Okay, and that's really simple. There it is. Go read the book. I've already given it to you. I've stated in there what the answer is. Luckily, 5 years out of 7, that little baby goes up. So you don't have to worry about it. Okay. That's one of my students at an airport. My students are the best people in the world because they are addicted. So he sent me this picture. I can assure you that is not my thumb sending myself a picture. But it does look like my thumb. But it's not. I can't remember where he was going. He was going on his honeymoon. I posted this. He was going on his honeymoon, and it's myth, and I hope you don't mind me telling people. He was going on his honeymoon. He messaged me. He goes, look, I've taken this. And I'm thinking, oh my God, I hope that marriage lasts because he's taking me on his honeymoon. I posted an article on LinkedIn. If you're not following me on LinkedIn, please do. alpeshpatel.com/links. You'll find me on LinkedIn there. Okay. I'm going to take up the S&P in a second. I might have to break this webinar into 2 parts because if you think I'm going on too long, please tell me and I'll break it into 2 parts and do the second part maybe tomorrow or something, if you think I've gone on too long. But if you want me to continue, let me know as well. Mark, I'll come to that in just 1 second. Content regarding HubSpot, which I bought as a hedge fund pick, it was since gone up 30%. Now, this is another problem we have, and I'm going to address this as well. Start with a 50% allocation, adding to winners, really good strategy. Okay, 50% allocation on 33, as it wins, you add more. Added additional 50% allocation, as you recommended, added to winners. Okay, one of the things that I teach them a few little things if they've got the time. If they don't, then we do it slightly differently for them. Okay, so what do you do when something's gone up a lot? Well, we show them that actually what you can do is just say, if it drops X, I'll sell Y. If it drops X, I'll sell Y. You work that based on your risk appetite, not on me being able to see the future, because I can't see the future. If it drops X, sell Y. That's how we ended up in NVIDIA for so long, because it never dropped X. I remember that I first joined, you mentioned you were going to buy some XRP, buy and not look at it. I literally did nothing for ages. I know it did nothing. It was a stinker. Suddenly, having very quick 254% up. That came up. Well, that's thanks to Donald Trump. I didn't know that was going to happen. And that's not part of the program, by the way. XRP is not part of the program because the program is not to do with crypto and those kind of things. Hope you all. Partly I decided to stop the buy in middle. It was toast. This, I believe, was one of your intermediate term picks. Yes, because it hit enough of our criteria in the Excel spreadsheet. I've gone up roughly 50%. What to do? That is, if it drops X, sell Y. So now you know the flip side, what to do when things do skyrocket, because there have been a lot in the market, not because of me, because they have. If it drops X, sell Y. If it drops X, sell Y. I've now also started doing weekly news updates, macro updates, basically using all my resources. So I do a lot of stuff in Parliament. You hear a lot of stuff in the hedge fund industry, international politics. She's now basically, if she gets confirmed, then the head of the CIA and the FBI will be reporting to Tulsi. Anyway, so yeah, I try and use that for macro. This is the holy grail. There's two holy grails. One, well, actually, there's several holy grails. One, you manage your own money. Why? Because that's what SIPs and ISAs were created for. You manage your own money because nobody cares about your money more than you do. Right? Don't take my word for it. Nobody cares about your money more than you do. Well, maybe your spouse does, or your children, but nobody cares about your money more than you do. So you manage your own money, SIP and ISA. All right. Second, have the data. If you haven't got the data, you can do bugger all. If you've only got limited data, if your source of data is Fox News, you're screwed. Okay. 3, don't pay subscription fees every day, every week, every month, because you're just paying for somebody else's school fees. All right, like an IFA or from a preferably, I don't think you should. Okay. And 3, know what to do. Know what to do, and does it make sense to you? Not to take my word for it. Does it make sense to you that undervalued companies do better than overvalued ones? I can show you the research from Eugene Fehmer. Look him up, Nobel Prize winner. I can show you the research that growth companies do better than non-growing ones, and we want a subset of both. Cash return on capital invested, that comes from Goldman Sachs Wealth Management. I'll show you the slides in a second. But you don't have to take my word for it. Do you think companies that generate cash, a lot of cash based on their capital, tend to do better? Not necessarily. There are exceptions, Alpesh. Yeah, but do you think overall they tend to do better than ones that don't? The ones at the top of the pile do better than ones at the bottom. What do you think? Okay. Momentum comes from the hedge fund industry, and Sortino already explained, and alpha. That's what we wanted all. That's it. I simplify because I'm lazy. This is from one of my students. And what I like about this is this. They look at the last percentage drop, so they're aware what an individual stock can do. And then they look at the potential loss and they say, well, do I want this? And the time to recovery. Now, if they didn't want that, let's say they said, oh, that's too much, then they won't have those stocks. If they said, no, that's too much, they'll put less money in. Okay. That's important as an exercise. This is the exercise that most people don't do because they think, oh, Alpesh will be able to go in his time machine, see in the future and give me a 500% rising stock. No, what they don't look at is, wait a minute, what's the ride? How bumpy is that ride going to be? And do I want to take it? If they don't, then they've got to narrow down their choice of stocks to have. And it might be that they have to have more of this one and less of this one. And that's perfectly fine, as long as it suits their appetite. And our job is to make sure we suit their appetite. There's no point forcing somebody to take this, which is what a fund manager does. He says everyone's got to have the same bloody portfolio. Well, that's a bit bloody unfair. Everybody's got to have the same portfolio. That's simply not fair. Okay, this is where we are with the FTSE. I'll show that in a second. This is the poverty gap you are facing, US between UK and US. All right, that's the UK. Over the last 10 years, the UK has given you a 41% rise in your pension if you just tracked it. Not Alpesh, you tracked it. Okay, you don't need me. If you tracked it, that's what would have happened. That's what the US gave you. Not me. I'm just giving you some history. That gap between UK pension and US, because UK pensions don't have US and the UK government wants you even fewer people to have it now, even though you're allowed them in your SIP and ISA, which they never tell you, right? That's going to get worse. That gap's going to get bigger. That gap is going to get bigger. Don't take my word for it. Go read the news. What do you think? Do you see the UK closing that gap anytime soon through some amazing outperformance over what's happening in the United States? No. This came today, literally 2 hours ago. Okay, that came today. Exceptional program, 65% over 2 years. Different people are going to get different results. Method of teaching mentoring is best I've come across because I teach you one-to-one. That's why I stole that from Oxford University, one-to-one tutorials. I'm a glorified driving instructor. Once I've taught you, you don't need to keep coming back to me, but you can keep having driving lessons if you wish, but you don't need to. And I don't like people paying weekly, monthly, annual charges. Okay, there is no subscription. Been on the program for 2 years, volume and quality of content has doubled. Yes, it has, because as we found people love the extra stuff, we've continued doing it. And Parish, I better let Parish know that came in today. This is what I suggest. This is from Goldman Sachs Wealth Management. Okay, people think it's a bit conservative. Got 25 years to retirement. You can have, say, 10% in cash, call it fixed income, and the rest in stocks. You might go 40% in stocks and 40% in exchange traded funds, i.e. low volatility, maybe 20 to 40 stocks, maybe 5 to 10 exchange traded funds, and the rest in cash. Okay, for cash, you should be getting at least 4.5% interest at the moment. If you're not, go to Money Saving Expert. You should be getting 4.5% at least in instant access cash. Call that fixed income for the moment. Okay, now I need to tick the value, growth, income, cash flow, Sortino, alpha boxes, monitor them frequently. 12-month holds. Why 12 months? I can go into that later. Don't worry about it for the moment. 15 to 40 stocks. Over 40, you're not going to diversify away single individual stock risk. Under 15, you've got too much individual stock risk. And generally, the exit is specific, but you could argue the exit is simply if it drops 25% from the entry within those 12 months, you exit, or you wait 12 months. That's the simplest version. There is a more complicated version, which is if it goes up a lot, as I already showed you, then if it goes up X, sell Y. So it's more bespoke to each individual. They just called me up and asked. And this is why you want between, say, 15 to 40 stocks, not more. All right. I've written about it in the books. I've just given you one of the books there. This is how the market's looking at the moment. Okay, it's a bit of a, listen, it's 10:22. I actually am going to do this part, okay, where we go through the earnings calendar tomorrow. The past week, past year, exchange traded funds, where we're at. So I'm going to give you a preview of what we're going to cover tomorrow, okay? Year to date where we've got to. The reason is I've talked too much and the market's 1 year. So I'm going to cover the S&P where we are on this. And don't worry, it will be recorded. So I'm going to do that tomorrow only because I'm keeping you too long and I've gone on too long and I apologize for that. That's where you'll find everything, including you'll find my LinkedIn and all the rest of it there. And if you want to see anything in detail, schedule a call there, alpeshpatel.com links. Okay, I'll also go through some of the bank picks from some of these. It's just that I've gone on so long, but I'm showing you the slides anyway, the things that we're going to cover tomorrow as well, and how and why it's important to narrow things down. By the way, that's United Health, one of the most popular, well, the most popular stock on the S&P. And I'll go through some of this stuff as well. But I'm going to answer some anyway, one or two of the questions that are on here. And we'll look at some of these and how we cross-reference it with what's in the most popular funds, because the most popular funds are the ones with the tons of money. So I'll go through that tomorrow as well, and how we didn't know we were going to get 250% return, because if we bloody did, I would have gone to Ladbrokes and said make the odds on it. But how we cross-reference it with what the analysts are saying as well. Dwayne, I don't know, but I'll make sure that I will give you a recording anyway, so don't worry, and we cross-reference it with what the biggest banks are saying. So really, and cash flow, really belt and braces on all of that, and to see if any hedge funds own some of things on our list. So it's not just me and my Excel spreadsheet, it is what are the biggest banks saying? Do they also have this stock? Do the biggest hedge funds have it? How has it moved over the last 20 days? Is it too volatile so that it would hit a stop loss and so we don't want it? Or is it less so? So we'll look at all of those things and provide that data to the client. So the client has that. So they only need to spend 7 minutes picking the ones which fit their risk profile of not dropping too much, and so that they get closer to all of this. I mean, with some of my clients, they just say, listen, I've got time to all of that. Just tell me how I get that kind of tracking result, and how do I avoid the big falls like this. So some of the clients are just, listen, just tell me, just call me, Alpesh, if you're going to go into cash. Until then, I don't need to hear from you. Okay, we've got 1 or 2 clients like that. Just call me. And this is the warning, just a reminder, if you're on St. James's Place, Fidelity, 91, Bailey Gifford, Lion Trust, that's your problem. Relative performance, they're screwing your pension. Please, please, please do something about it. All right? We'll talk about doubling your money. This is why I said 32% is what I'll get over the next 2 years. It wasn't me. It's because that's statistically the positive returns 88.5% of the time. I'm just playing the odds. All I did is play the odds. Okay, so again, I'll go into that tomorrow. I'll go into some more, like Trevor Atkin, who's seen good results as well. If you want to hear from more of the clients, have a look at alpeshpatel and there's videos with clients on there. If you want to open a SIP or ISA, you don't have to do it at Barclays, do it at any broker, but it's very easy to open. Anybody can do it. Again, all of these things we'll talk about tomorrow, and some of the stocks and the stock market updates and what's been moving, what hasn't as well. And we'll go through Netflix and Walmart and all of those. Okay, so all of that stuff will come up. That's the first column that I talked about earlier, Uncle Sam, US transaction costs as well. And why we cross-reference stuff with hedge fund ownership, because we're not the only one. We're certainly not the biggest. We're not the only one who has good ideas. So we cross-reference it to see if any of the ones on our filtered list also happen to be held by any of the big funds. And lo and behold, they get paid the big bucks for picking Amazon, Microsoft, Meta, Visa, MasterCard, Alphabet. Are you kidding me? PayPal, ServiceNow, Salesforce, Alibaba, Netflix. What? Yeah, in my industry, get paid the big bucks for stating the bloody obvious sometimes. So I'll explain that to you and how we came about some of these holdings and why, for instance, and this is an important point, in 2020-21, when I launched the Great Investments Program, outside of all the stuff that I do, we had some good results, not because of me, because there was a tailwind. There was a tailwind in the market. You know, I'd love to take credit for it, but that's called the God complex, and I don't have the God complex. So like I said, have a look at alpeshpatel.reviews.com. And 40% is realistic only if you get a tailwind like 2023 and obviously 2024, because you'll get an Nvidia or a Meta or a Stone. We didn't know we didn't know the narrative behind any of these stories. Didn't know the narrative behind any of them. Okay, it was the data and the market tailwind. That's what gets you 80%. Market tailwind. Now, you don't have to do that. You can just do an index tracker and leverage it. This is the croaky one I mentioned earlier from Goldman Sachs. That's the slide. We base it all on data and information, and we take data from Goldman Sachs Wealth Management. We take data and know-how from Nobel Prize winners like Eugene Fama, Daniel Kahneman, Richard Thaler. Nothing that I've said to you is an original thought. It is all being taken from the best brains out there and then put together for obvious reasons. You know, it's like the Tesla car. Musk took all the best brains and put them together and said, make a car, or iPhone, you know, get the best designers and the best electricians, all the rest of it to make the damn thing. Electricians, probably not so much. So yeah, I'll go through all of that. There it is. There's the AI pick, 83%. So by December of last year, from May 2023, it was already up 83%. That was the Broadcom one, which I sort of was a bit of a standout. Like I said, we'll go through all of that and why people like this and they like the one-to-one calls. These are the two things people want. I can delete everything else. The only two things they want is the Excel spreadsheet and the call with me. The calls with me. And if you want to join, I'll make this open tomorrow to anybody. If you want me to hold a place till tomorrow, I'm not going to let anybody on today because all of you might come tomorrow. But if you want me to hold a place, let me know. And if you want to know more, go to alpeshpatel.com links. And Paresh, who co-founded a hedge fund and co-authored the books with me, will happily show you what we've created out there. I'll show you this for tomorrow. Okay, I'll save this for tomorrow. If anybody wants to reserve a place, let me know, but I'll save it for tomorrow if anybody wants to join the program. My ambition with the program is to float the company because I want it to be a different type of asset management company. I want it to be the kind where you manage your own capital. We just give you the data and the know-how. So we don't have any of the cost or any of the problems of managing your capital, but also we can honestly then tell you, hold cash this year, because we don't have a conflict of interest with you. I think it's ingenious, which is why we've got people from around the world. I want to get to about 350 people before I take any outside venture capital money in. We're up to 300. I was going to originally take 250, but it's going so well, getting so much data from people. And that's what they want. They want the data, they want the expertise. So I'll go through that and the markets, as I said, tomorrow. They want these stocks, they want the 6,000 funds, they want the updates, but they really want to speak to me just to double check over their shoulder with the data what we've suggested is the right drawdown. And the main thing our job is to do is to work out their risk appetite and the biggest drawdown that historically what they might be holding would have. So we're actually just doing a data job for them. A bit like a plumber is blocking a leak for them. It's just to say to them, that's your risk tolerance. Therefore, this meets, that one doesn't, this one does. From the list, our approved list. So we filter down our approved list and that makes things easier. We have a lot of business owners for that reason, because of course they get it. They get business, but also they know they want, and professionals, they know they've got to make their money work hard for them. Thank you. Sorry I overshot, but I'll make sure. May not work tomorrow, it's Christmas Day. I know. I'll try and do it in the afternoon, Peter. Merry Christmas to everybody. May you have a peaceful Christmas. And given it is Christmas, may you well, all remember the teachings of the Bible and peace and love and joy to everybody. So I think we can all agree on that, whatever faith we're from. So yeah, Merry Christmas, and yeah, let's contemplate the serious part of Christmas, not just the fun part, and peaceful time with your family. I'll try and do this tomorrow afternoon for everyone, okay? And also, if you don't get a chance, have a look at campaignforamillion.com. As well. I know there were some questions. I might email reply those questions because I don't want to keep people beyond me. It's 10:30. I apologize if it was so late. It's just sort of trying to work out the right timings, which would suit everyone. If there's any questions I've not answered, which I know there are, just email me and I'll answer them by email. alpesh.patel@tradermind.com. Okay. By the way, I was asked that the other day by somebody, well, how did you come up with tradermind.com? My first book was called Mind of a Trader. It was published by the Financial Times in 1997 when I was a student, I interviewed 10 of the world's leading hedge fund managers. And so the company got called, so the URL .com became TraderMind from Mind of a Trader. So somebody had asked me that. Thank you, Guy. Thank you, Darren. Apologies I overshot. Really unprofessional of me to overshoot, but there's just so much to cover. So I'll cover the stock market bit, and I will make sure for anybody who can't make it tomorrow, you just email me or whatever, and I'll make sure it is on social media, whether it's on my YouTube, and you can find all of that through alpeshpatel.com/links. So whether it's through, YouTube or TikTok, that you will get access to it. But I apologize for overshooting. If anybody does want me to reserve a place on the Great Investments Program, just email me. Several of you have actually private and public Q&A, only private. Thank you. Yes, I've got a few private emails here. I'll make sure I hold a spot for you. Don't worry, not a problem at all. Okay. Thank you. Any questions I might have missed, just email me and I'll make sure I do them. Thank you, everyone. Apologies, like I said, I overshot a bit. I'm going to try and do more of these before the new year because I know there's a demand for it, and I'll try and keep them shorter as well. But I know there's a massive demand because people have got a bit more time. So thanks once again, everyone. Okay, I'm going to go now.